Welcome back to the channel. In today's video, I want to talk about volatility and investing. It's one of the most important topics regarding investing. And essentially, for those who cannot endure volatility, it's going to be a difficult investing journey. And for those who can, they're likely to attain much higher results than their neighbor or their friend who essentially indulges in over trading, panic selling, so on and so forth. Warren Buffett called people like that hyperactives, people that engage in over trading. But let's get started here. And what it's a perfect opportunity to do this video because I have had exceptional volatility in both of my portfolios. It hasn't been, kind of a straight shot up or a straight shot down. It's been, up pretty tremendously and then down, so on and so forth, and back up. So it's a great learning experience for a novice investor, really any investor. So you see my cost basis here is 290 in this composer portfolio. I run over 100 symphonies here. And so you can see here, let's scroll down here. This is February 12th. I was at 312. And the portfolio peaked right here Thursday, March 7th. I believe I was in Montreal, actually. I have to check my calendar at that time. But anyway, so Thursday, March 7th, I was at 327,000 from 290. So, so it was up, $37,000 from January 11th, I think, or 17th when I launched this portfolio to here. But then you can see it's been kind of a slow bleed thereafter. So from 327 down to 315, kind of holding the line here, if you will. Now we're at the end of March. And then right here, this is April 3rd. To April 4th. So a big down day here from 314. So that day was down, 11,000 just alone right here. Kind of flat, down again here, a pretty big day. A little bit of a rally here. And then right from April 11th, okay, to April 19th. So that week from the 11th to the 19th, I was still hanging tough here at 315. I went all the way down to 276 on April 19th. So again, we're back here, 327,000 on March 7th. So from March 7th to April 19th, so for 5-6 weeks, basically there's a decline here of $50,000, 51,000. We can do the exact math here and pull that up. I think that's about 15%. So tremendous decline there. It's not a 30% decline. It's a 15. So it's a decent sized decline. But in actual cash terms, it's 50,000. And many people watching this might think, "Wow, that's my salary, or that's 75% of my salary, and it's gone in 5 or 6 weeks." And that's why I feel that, and this is somewhat related to this. I feel that those who can harbor an aristocratic worldview regarding investing, even if it's manufactured or phony, then those who have a working class mentality will do better. And what do I mean by that? Lines like, I've worked hard for my money. No one ever gave me anything. I'm not made of money. Money doesn't grow on trees. All these sort of working class aphorisms generally lead one to be tighter, if you want to use that term, and more risk averse, where they're not able to stomach a $50,000 decline. I believe it was Jack Bogle that said if you can't deal with a 30 to 50% decline in your holdings 2 or 3 times in a lifetime, then you shouldn't own stocks. You shouldn't invest in the stock market. Just own treasuries or whatever you want to own, or gold or silver. So that's pretty significant decline there. But then what happened here is to mention Bogle, and this is the way I view symphonies, and I realize that I'm on Mars here, and many others are on Venus. So I view my symphonies like like buy and hold ETFs or mutual funds. I don't trade in and out of symphonies. I allocate to a symphony, essentially how others allocate to VOO, QQQ, and DIA, or a Fidelity contra fund or whatever, right? So I'm not looking to kind of panic sell here and say, oh, the strategy is doomed, it doesn't work any longer, I'm going to jump to the next shiny new object. So you can see here that since April 19th, we've climbed from April 19th to Friday, April 26th to 308.14. So if we scroll up here, this is where I am for the year, 308. And SPY is at 7.26, I believe. So kind of tracking SPY about almost exactly 1 percentage point behind. I kind of tracked SPY last year, and then I really pulled ahead the middle of November until the end of the year. And I attained, I think SPY last year was like 26%. I was 33. So attained a significant alpha over SPY last year. So we'll see this year, but so far, not so bad, kind of tracking it here, but really just showing that like the Bogle line that I wanted to reference is don't do something, just stand there. Let me say it again because it's the opposite of what you're thinking. Don't do something, just stand there. And so just by standing there at 276 here on April 19th, I allowed for recovery to occur instead of tinkering. So instead of the cliche is don't just stand there, do something, right? But in this instance, don't do something, just stand there. And so standing there has done well here. And yeah, so that's, we can go in here and, oh, another thing is you can see here, their app is nearly ready. So you can download that on the App Store, which will be cool to be able to, log in and check account values and such from my phone. I think they're kind of targeting that Robinhood crowd there that really, and just overall a younger generation of investors who invest through apps, Webull, Robinhood, but they're able to access that on their phones, not simply sit at a computer and execute things. So that'll be a nice feature to have. So yeah, so just down here we can see version 3A of the Manhattan Project, Sarbamba 1.2, doing well here. Teachable Crew for the long term. Sabeta Baller's done well. Moonshot, Wishcasters. So these are some of the leading ones so far this year. Thales of Miletus for my fellow Greek. So yeah, now let's shift over here, and I just want to show the same thing here in my vanilla account, if you want to term it that. So this one has a lot more capital than the Composer, and let's see if we can bring this here. Yeah, it's the other side, perfect. So year to date, you can see 5.8. That's actually higher, and I'll get into that in a second. So you can see January 1st, 524. We're at 555, so up 30,000, and we're actually up almost exactly the same percentage SPY, 7.3, not 5.8. The reason being is, and I don't want to get too in the weeds, I always say that, you see this option value here is negative 8,295. You need to add that back because that's the position if I were to close positions, but I hold the expiration. So it's sort of a false number, if you will. So when you add that back, it brings it over 560, and it brings this to 7.3%. So just a little bit above SPY. But you can see here, so let's look at this account. So now the other was March 7th. This one, it looked like it peaked on March 28th, the end of March, at that 573. Okay. Let's say right here, 573,128. So let's do 573,128 and 10 cents minus. So then you can see here in April, it starts selling off, dipped here. It starts to come back a little. April 9th, we were nearly back to where we wanted to. And then, I believe it was April 11th in the other account is when it really started to decline. Kind of the same thing here, maybe a few days earlier. But, right here, the 11th, down into 540. Let's go 539, 992, 28. So you see a decline of 33,000 here, and the other one was approximately 51. So let's just take 33 plus 51. So between these two accounts in those 6 weeks, capital declined by $84,000, and I didn't do a thing. And I believe the by not doing a thing, which means selling or repositioning or pouring over symphonies and the logic and saying, well, is this wrong, is this, and tinkering and essentially making a mistake. That's why I feel I'm a 7-figure investor, that I've gotten to this point, because I bring that Jack Bogle, Warren Buffett, Charlie Munger long-term thinking viewpoint to all forms of investing, be they algorithmic investing, be they buy and hold vanilla funds, be they options. Just have a longer term sensibility, which I believe gives me a true competitive advantage over others. And it kind of goes back to like when I mentioned this in one of my other videos, like when you look at when they do studies on the index fund or mutual funds, they'll say, the fund has returned 11% over the last 20 years or 15 years, but the average investor in the fund has returned 7% or 6%. Why? Because when the market went up, they had FOMO, fear of missing out, and they piled into mutual funds or index funds or whatever they're piling into. And then when the market goes down, they panic sell and go to cash and think, I'll just wait it out and try to get in another time. So by not following the herd, I've done quite well, as you can see, here, just on the very size of these two accounts. So that just kind of gives you, a sense of the volatility. And what's nice about this account, the way I've set up, is I'm essentially creating an income portfolio with this one. I've taken home already, I want to say about $3,800 in option premium. Remember, I sell options, I don't buy options. Generally, unless I'm doing an iron condor or a credit spread. But generally, I'm the seller of options. And you can see here, if you go to investment income, so let's come down here. It looks like February will be the last month, I want to say ever. Let's say that and put it out in the universe, that I'll be under $1,000 in dividend income in this account. So you see January 1,200, you see March 17, here 965 plus 3, that's expected 350. So that'll put me at about 1,300 or so this month. You see 18, and this is expected here for May. Not going to be exact. Over 2,000 in June, 1,100. So July could be dicey, maybe, hopefully not under 1,000 here, so 11. So it looks like, that's the goal, is to get this to that 1,500 to 2,000 range in dividends each and every month. Now, when you add that, so let's say, and I have options that are going to go out tomorrow, Monday. So if I'm at 1,300 here in dividends, and I am at right now 3,800 in premium, that's $5,100 in income just in this account. And so the power of this, though, is what I'm doing is I'm really trying to live frugally and not have to go into this as income. A lot of retirees will do covered calls for income, then use that income. What I'm trying to do, I'm 44, the next 5, 10, 15 years, is to do options, but to then put them back into the account and buy assets with them, so it accelerates compounding. That's what I've done the last few months, and that's kind of the plan there. So that just kind of gives you a sense of, that this account, the composer account, is really geared to attaining alpha. It's going to be highly volatile. You can see the composer account had a lot less capital, but it was down 51,000. This had only a decline of 30,000 and had double the cash. So the volatility is going to be much, much higher in composer. I understand that, and but I feel, and again, I could be completely wrong, I feel that it will give me at least several points of alpha, to SPY. So if SPY is 7 to 12%, I would not be surprised if over a long time period that Composer is 20 plus, or 15 plus at least. So we'll see on that. Last year was 33. This year it's not right now, right? It's at 6%. It's actually trailing SPY in the first part of the year, but we'll see how the rest of the year plays out. So yeah, so there you go. So just wanted to showcase, discuss volatility, but not just discuss volatility sort of in an abstract, intellectual, academic way. By showing the volatility in these two accounts, you can see how seven-figure investors, just on your volatility, is going to be five figures sometimes, and having the courage, the backbone, the spot, whatever you want to describe it, the mettle, the temperament, in order to withstand that, and withstand, the emotional impulses and panic. So yeah, so that is it for today. Feel free, any questions, comments. Look forward to interacting. Take care.